Hello and welcome to AI Market News by LM. This video's audio is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Welcome to the deep dive. Today, we're really getting into the thick of it, where politics, central banks, and the global financial markets all smash together. It's quite a mix.
Definitely.
Our sources cover a lot. Key currencies like the euro dollar, dollar yen, US stocks, the S&P 500, some big economic signals, and honestly, some headlines we didn't see coming.
Yeah, there's a lot to sift through.
So our mission today is to, untangle what's been moving the markets, get a feel for the sentiment out there, and see how these political moves can actually ripple through the economy.
Exactly. We'll try to cut through the noise, find those signals that really matter for understanding, what's actually happening right now in the financial world.
Okay, let's start with the big one. Our sources are calling it an extraordinary attack on Fed independence. This is all centered around President Trump's push to remove Federal Reserve Governor Lisa Cook.
That's the flag point.
Yeah, and it got serious on August 15th. President Trump's finance agency, the one led by Bill Pult, they wrote to the Attorney General.
Right.
And the claim is that Cook falsified bank documents and property records before she joined the Fed in 2022.
Okay.
Specifically, there's this 2024 form, U.S. Conference of Metaphysics, signed by Cook, listing 3 mortgages from 2021. One's an investment property, okay, but 2 are listed as personal residences.
And that's the rub, isn't it? IRS rules usually say 1 primary residence.
Exactly. Now, Governor Cook denies any wrongdoing, but we haven't seen a detailed explanation yet.
Well, and beyond the specific allegations, Elliot Stein over at Bloomberg Intelligence, he's a litigation analyst, he points out something important.
What's that?
He says these allegations, just on their own, probably aren't enough for cause to remove a Fed governor. You usually need, clear inefficiency, neglect, or malfeasance.
So cause is the key word here.
It is. The Federal Reserve Act says the president can remove a governor for cause, but, and this is crucial, it doesn't actually define what cause means.
Leaving it wide open for interpretation.
Totally. A big legal gray area.
And it sounds like a legal fight is coming. Lisa Cook's lawyer, Abby Lowell, interesting side note, he's represented kids of both Trump and Biden.
Oh, really? Yeah.
Anyway, Lowell says they will sue if there's an attempt to remove her. So the big question for the markets, for the Fed's functioning, does she stay on the board while this plays out in court?
That is the critical point. The Fed itself put out a statement, backing transparency, saying these removal protections are a safeguard. And they flat out said governors may only be removed for cause. Plus, there was that Supreme Court decision back in May.
Right, the one suggesting the Fed has some shielding from politics.
Exactly, calling it that semi-quasi-private entity that shouldn't face political pressure. It adds another layer here.
So Betsy Duke, former Wells Fargo chair, she called this whole thing a real assault on the independence of the Federal Reserve System. Pretty strong words.
Very strong. And she said it threatens every FOMC member, potentially.
She even thinks it could go all the way to the Supreme Court. The debate being, what causes more harm? Removing her now or letting her stay while the legal battle drags on?
And if we step back, connect the dots, President Trump's move looks like a play for control, specifically control over the FOMC, the rate-setting committee.
To get lower interest rates, presumably.
That seems to be the goal, yes. And think about next February. The Fed board gets to reconfirm the regional reserve bank presidents who vote on the FOMC.
Okay.
If Cook is removed, you could potentially end up with a 3-3 deadlock on the board.
Which could block some reappointments.
Precisely. And then maybe allow a president to appoint people more aligned with their rate preferences. Lael Brainard, former Fed vice chair, warned about this kind of thing.
What did she say?
She warned that political interference like this could actually backfire, push up inflation and long-term interest rates.
Interesting. Okay, so huge political storm brewing. How did the markets react? You'd think they'd be rattled, but our sources say August 26th was rather mundane.
Yeah, kind of surprising, wasn't it?
The S&P 500 was up just 0.2%. That was after falling 6 the last 7 days, mind you.
A little bounce, but nothing dramatic.
And the dollar, it was weaker against the other big G10 currencies initially, but then looking at the 27th, the yen actually fell against the dollar. That pair, USDJPY, was trading around 147, 148, seemed to stabilize a bit.
It's a nuanced picture, isn't it? Stephanie Larosiliere from Invesco had a good take, I thought.
What was that?
She said markets are basically in wait-and-see mode. They've sort of learned not to freak out over every single political headline because, a lot of stuff gets said that never actually happens.
Right, policy doesn't always follow the rhetoric.
Exactly. And she emphasized the Fed is still data-dependent, regardless of any dovish comments floating around.
But here's where it gets really interesting, I think. While equities were calm, the bond market definitely wasn't. We saw the yield curve steepen.
Yes, that was significant.
Short-term yields fell, suggesting people expect rate cuts sooner rather than later, right?
Bracing in maybe a September cut.
But long-term yields went up. The 30-year hit 4.94% briefly on the 26th. The new 10-year yield got to 1.625% on the 27th highest since, 2008?
Yeah, a long time. And the new 30-year hit 3.235%, a record for that specific bond since it started in '99.
So what's this steepening telling us? It seems contradictory, lower rates expected soon, but higher rates long-term.
It really reflects investor anxiety, I think. Deep anxiety. The short end falling, yes, that's about Powell maybe sounding a bit dovish, hopes for a cut.
Right.
But the long end rising, that's the market pricing in worry. Worry about central bank independence being chipped away.
The political risk premium.
Exactly. Worry about maybe higher inflation down the road from tariffs or big deficits. And worry that if the Fed does become politicized, an ultra-dovish Fed, it might not be willing or able to fight inflation effectively later on.
So are the bond vigilantes waking up, demanding more compensation, a higher term premium for holding long-term debt because of this increased risk?
That's the question, isn't it? Are they signaling they need to be paid more to lend to the government long-term because they see more political or inflationary risk? It certainly looks like it could be the start of something like that.
Ken Rogoff at Harvard had a comment on this. He said, while Trump often acts pragmatically, undermining institutions like the Fed, well, it's not good for long-term growth, not good for stability.
Right. The concern is you get this self-feeding loop where expectations of inflation start to rise because people doubt the Fed's commitment, and that makes inflation harder to control.
Is there a historical parallel for this?
Oh, definitely. The classic example is the early 1970s, Nixon pressuring Fed Chair Arthur Burns to keep rates low.
And what happened?
Inflation took off. It really accelerated. That whole experience created this sort of don't be a Burns mandate for Fed independence.
So bond investors today might be looking back at that history.
I think they are. They fear a repeat. That's why long-term rates might be climbing, even if the Fed cuts short-term rates soon. They're demanding protection against that 70s-style scenario.
Okay, so the Fed drama is huge. But other things are happening globally too, right? Our sources mentioned India.
Yes, big news there. On August 27th, the U.S. slapped a 50% tariff on some Indian goods.
50%? Wow, that's on top of an existing 25%.
Effectively doubling it, yeah. It's presented as a sanction because India keeps buying Russian oil.
And this affects a lot of trade.
Over half, 55% of India's exports to the U.S. apparently. Things like textiles, jewelry, labor-intensive stuff.
That sounds like a major blow to U.S.-India relations.
The sources called it exactly that, a new blow. India's basically said, look, we're getting economic benefits from Russian oil, and they're strengthening ties with BRICS nations.
So this is quite a shift from the U.S. trying to align India against China.
A significant shift, yeah. Shows how complex these geopolitical currents are.
Let's switch gears to tech. The AI boom. All eyes were on NVIDIA's earnings, right? Due after the close on the 27th.
Absolutely. Seen as a huge test for Wall Street's faith in AI.
Expectations were massive. Revenue around $46 billion, a 50% jump year on year.
Incredible numbers expected. Adjusted EPS around $1.01. But there are those underlying concerns.
About China.
Yeah, geopolitics again. Can NVIDIA keep doing business effectively in China? There were reports China asked its companies to limit buying NVIDIA's H20 chip.
So it highlights that ongoing U.S.-China tech rivalry.
Definitely. And the market sets such a high bar for NVIDIA, it often needs to blow expectations out of the water just to keep the stock momentum going.
Meanwhile, speaking of China, their stock market's been rallying hard.
Yeah, a $1 trillion rally in the past month. Based on the sources, the CSI 300 index up over 20% from its lows this year.
What's driving that?
Seems to be a combination of slightly easing U.S.-China trade tensions and government stimulus measures kicking in.
But Is it getting overheated? Is it sustainable?
That's the worry. There are signs of caution. Wargin Securities in China apparently raised margin requirements on some stocks to 100%.
Okay, demanding full cash upfront.
Right. And some funds capped daily purchases. It signals concern about risk. Plus, new borrowing for stock purchases hit almost 12% of trading volume. That's a high since 2015.
Sounds like FOMO, fear of missing out.
Yeah, classic FOMO driving some of that rally, it seems.
All right, let's hop over to Europe. France seems to be facing some political turbulence.
Big time. Prime Minister Attal called a confidence vote for September 8th.
And the opposition might actually topple the government.
They're threatening it, yeah. Major opposition parties. And this is really dashing hopes of a business-led recovery, as one source put it.
How markets reacting there?
Pretty clearly, French stocks are down, especially banks and companies focused on the domestic economy.
And bond yields.
The spread between French and German 10-year yields, a key risk indicator, widened out to nearly 80 basis points. Some analysts worry it could even hit Italian levels, around 100 basis points, if this instability drags on.
So businesses are getting nervous.
Understandably. Reports say companies are pausing hiring, putting investment plans on hold, just waiting to see how the politics shake out.
Okay, one last sector note. Offshore wind.
Ah, yes. Mitsubishi Corporation in Japan pulled out of 3 big offshore wind projects.
Why?
Costs basically spiraled. Construction costs doubled what they expected, and they just couldn't see a path to making money on them.
And we've seen headwinds for offshore wind in the U.S. too, right?
We have. The Trump administration reportedly moving to block a project off Maryland. It just highlights that even with climate goals, the economics and politics of these big renewable projects are challenging right now.
Okay, before we wrap, a couple of, well, stranger things that popped up in the sources.
Always some curveballs.
CME Group, the big exchange operator, partnering with FanDuel, the sports betting company.
Yeah, I saw that. Offering bets on stocks, commodities, even GDP data.
Right. Using things like smaller size contracts, simple yes or no contracts. It feels like it's blurring the line between betting and investing.
It really does. Trying to reach that retail crowd clearly definitely raises questions about the gamification of finance.
And then, completely out of left field, President Trump commenting on Cracker Barrel's logo.
Wait, really? The restaurant?
Yep, they did a rebrand. He apparently suggested they go back to the old logo, and the stock jumped over 5% on the news.
Get out. That's something else. Presidential influence on corporate branding.
It's just a weird little market moment. And one final tiny tidbit, because it even made market commentary. Taylor Swift and Travis Kelce got engaged.
Huh. Okay. That definitely wasn't on my financial news bingo card.
Yeah.
White House well wishes and everything.
It just shows you, even huge global events share the stage with pop culture sometimes.
It all just highlights how interconnected everything is, doesn't it? I mean, you go from allegations against a central banker potentially moving global bond yields,
Right.
to tariffs changing trade flows, to, well, presidential logo opinions moving a stock. It's all in the mix.
So the big takeaway question maybe is, how does this struggle over central bank independence play out long term?
Exactly. That feels like the crucial thread. How will that shape the economy over the next decade? Especially with inflation pressures and government spending a lot. It's a fundamental tension.
A huge question to keep watching. Well, that's our deep dive for today. We covered a ton of ground, from the Fed drama to market moves, global politics, even Cracker Barrel logos.
We certainly did. Lots of moving parts.
It really shows all the forces working behind the scenes. Thanks for watching. Don't forget to like and subscribe.